Hey everyone, welcome back to Corporate Decoder, the place where we might just find out if Defense Technologies International Corp is truly defending itself or just digging a deeper financial hole. So buckle up today, we're diving deep into their latest 10Q filing. And let me tell you, it reads like a financial rollercoaster with more twists and turns than a daytime soap opera. We're going to cut through the jargon and get to the heart of what these numbers really mean for the company. And before we dive in, if you love getting straight answers from these dense filings, make sure you are subscribed. We also have a fantastic Discord community linked in the description below, where we break down these reports together. Looking at their balance sheet, the most striking thing is the sheer scale of liabilities compared to assets. For the 6 months ending the 31st of October 2025, they reported total current assets of a mere $7,662, while their total current liabilities stood at a whopping $2,477,014. That translates to a working capital deficit of over $2.4 million. That is a serious shortfall, folks. Let's break down where these liabilities are coming from. A huge chunk is made up of payables to related parties at $937,877, along with notes payable totaling $541,288. They also have significant amounts for accrued interest and fees payable at $233,491 and convertible notes payable, net of discount, at $215,392. It is clear this company is heavily leveraged and relies on a complex web of debt and obligations. Now, let's talk about what is left for the owners, the stockholders. Their total stockholders deficit is a negative $2,469,352. This isn't just bad, it is a red flag. It means that if you were to liquidate all the company's assets, you still wouldn't be able to pay off all its debts. The accumulated deficit alone is a staggering $18,439,015. This tells us that the company has consistently spent more money than it has made over its lifetime. When we look at the statements of operations, the story remains the same. For the 3 months ended the 31st of October 2025, they posted a net loss of $159,942. Zooming out to the 6-month period, that loss balloons to $382,106. This is a far cry from the net income of $398,527 they reported in the same 6-month period in 2024. The company is clearly struggling to generate any meaningful revenue. For the 3 and 6 months ended the 31st of October 2025, no revenue was reported. This lack of income is compounded by ongoing expenses. Consulting costs alone were $180,250 for the 6-month period in 2025, down from $336,792 in 2024, but still a considerable outlay. Interestingly, in the 6-month period of 2024, they had a substantial gain on debt settlement of $723,065. This suggests they were able to negotiate down their debts, which is a positive move, but it doesn't erase the fundamental issue of not generating sales. The going concern note is especially concerning. Management admits that they have no revenue, a massive accumulated deficit, and a working capital deficit, raising substantial doubt about their ability to continue as a going concern. They plan to fund operations through issuing debt and equity and through support from related parties. This is a risky strategy, relying on outside funding without a proven revenue stream. The company's reliance on related parties is evident throughout the filing. For instance, their loan agreement with EMAC handles, ADGI shows an outstanding balance of $117,708, plus accrued interest as of the 31st of October 2025. Furthermore, payables due to related parties are a significant part of their liabilities, totaling $937,877. Their debt situation is quite complex. They have various promissory notes, some with significant discounts indicating a discount rate likely reflecting the company's perceived risk. For example, a note issued on the 11th of July 2024 for $50,000 had an initial discount of $10,000. This means they effectively received only $40,000 for a $50,000 debt. This practice hints at desperation for funds. The convertible debt section further highlights the company's financial strain. Notes are often converted into stock at discounted prices, diluting existing shareholders' value. For instance, a note entered into on the 3rd of August 2016 has a balance of $12,500 plus interest and is currently in default. This suggests they are struggling to meet even basic repayment obligations. The fair value measurement section, particularly the derivative liabilities, indicates that the company uses complex financial instruments, possibly to manage risk or structure debt. The significant expected volatility of 254.00% for their derivative liability calculation suggests extreme unpredictability in their stock's value, which is not a good sign for stability. Looking at their equity structure, the authorized shares of common stock are a massive 600 million. As of the 9th of February 2026, there were over 37.5 million shares outstanding. When combined with the preferred stock, this indicates a significant potential for dilution for common shareholders. The Commitments and Contingencies section reveals ongoing administrative and service agreements with entities like EMAC Handels AG and Merrill W. Moses. These agreements dictate regular payments which are a fixed ongoing cost for the company, regardless of its revenue generation. The Subsequent Events section mentions a note issued on the 29th of January 2026 for $6,000 with an original discount of $1,000. This indicates they continue to borrow money with unfavorable terms, even after the reporting period ended. Now, let's talk about the business itself. Defense Technologies International Corp is focused on security products, specifically passive scanning units. They offer a passive portal for weapons detection, and also a version with an elevated body temperature screening feature, which gained prominence during the pandemic. The idea is to provide passive scanning technology for places like schools and public facilities. The most critical takeaway from their results of operations is the striking lack of revenue. For both the 3 and 6 month periods ending the 31st of October 2025, the company reported zero revenue. This is a fundamental issue. A company cannot survive long-term without generating income from its operations. Their strategy seems to be entirely reliant on securing funding through debt and equity, rather than through actual sales of their products. Their liquidity situation is dire. With a working capital deficit of over $2.4 million, they are heavily reliant on external financing from related parties and other lenders. The management acknowledges this, stating, "We anticipate that in the short term, operating funds will continue to be provided by related parties and other lenders." The cash flow statements show a net cash used in operating activities of $93,577 for the 6 months ended the 31st of October 2025. This means they are burning cash just to keep the lights on, not to invest in growth. The company states they have no off-balance sheet arrangements. This means what you see on the balance sheet is essentially what you get. And given the current financial picture, it is not reassuring. Their internal controls and procedures are also flagged as not effective. They admit to material weaknesses in financial reporting, including insufficient segregation of duties and improper documentation of transactions. This lack of robust internal controls further erodes confidence in the accuracy and reliability of their financial reporting. So, what is my take on Defense Technologies International Corp based on this filing? Frankly, it paints a picture of a company in serious financial distress. Their entire strategy appears to be a continuous cycle of raising funds through debt and equity, often on unfavorable terms, to cover operating expenses, rather than generating revenue from product sales. The lack of revenue is the most alarming factor, and the mounting liabilities and negative stockholders' deficit paint a grim financial landscape. While they have innovative product ideas in the security space, their ability to execute and monetize these ideas is severely lacking. The reliance on related parties and the admissions of weak internal controls add layers of risk. The only real strength they seem to possess is the ability to secure continued external funding, but for how long can this last without any sign of revenue generation? The biggest opportunity, if they can weather the financial storm, is the market demand for advanced security solutions, especially with the addition of EBT screening. However, the risks are astronomical, with the foremost being their very survival as a going concern. To put it simply, this company is on life support, primarily kept alive by external funding. Without a dramatic shift towards generating sales, it is difficult to see a path to long-term sustainability. The stock price and shareholder value are likely to remain under immense pressure unless they can prove they can actually sell their products and become self-sufficient. Alright, that is our deep dive into Defense Technologies International Corp. Its latest filings, what is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more no-nonsense corporate breakdowns. And don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.